Thank you, Lee, and thank you all for giving us a couple of minutes of your day today. As Lee said, we're going to talk about the post-ACA era and hopefully provide some insights into not only how Hodges-Mace thinks about preparing for the post-ACA era, but also to give you some insights into some new product that we think will address some of the challenges. I think it was not a surprise to anyone that President Trump's administration immediately took on the ACA as one of their first initiatives. And we've now seen with the House bill coming through committee, we've seen some insight about what will happen, who will be impacted, and when it will happen. But there are an awful lot of questions. I mean, we are really seeing the legislative process play out in real time. What we tend to do at Hodges-Mace is we spend a lot of time thinking about how 5 separate constituents, folks that we deal with, the government, carriers and vendors, employers, employees, and brokers and consultants will be affected by any piece of legislation or any trend in the marketplace. So today what we're going to do is we're going to go really around the horn and look at the particular issues, the priorities, and perhaps the direct impacts of the post-ACA environment on each of these constituencies. First up, the government. I guess no surprise to anybody, but the biggest challenge or issue facing the government is this is a very highly politicized issue. However, as you've all noticed, there's very little focus on the employer market. The second challenge for the government is employee benefits are strongly linked to tax reform. So as reform of the ACA is really the first priority, the second priority is tax reform, both corporate, individual tax, and repatriation. So we believe that whatever comes out of the ACA repeal or post-ACA environment, there may be further changes to the employee benefits world linked to tax reform. And then finally, the government is still the largest source of health insurance for Americans. So how the government deals with the delivery of Medicare and Medicaid really influences all the other sources of insurance, both individual market and employer market. So their priorities clearly are repeal, replace, and repair. As I said, they're really not focused on the employer market per se, which is a bit frustrating for us who spend all our time there. They're really focused on the individual market and Medicaid. And I think the other thing that could even affect us even more than the direct repeal, replace, and repair, and that is the government's focus on deregulation. As you all know, employee benefits is that place where the Department of Labor, Health and Human Services, and the IRS all come together. So given the executive order to focus on eliminating or removing regulations, we think that it's going to continue to be an exciting environment in the employee-delivered benefit space as well. So what is the impact of the replacement plan? Well, one of the impacts is further divisiveness in the Congress, both houses. So we continue to see the rhetoric on both sides of the aisle, and that really doesn't help the benefit space when we're trying to talk about the value of benefits and the overall compensation. We also think the government's going to spend a lot of time looking at satisfying affected constituents, again, in the individual market and Medicaid. And we think there's going to be a fair amount of regulatory confusion. I think you're already seeing a bit of that as we deal with the DOL fiduciary rule, and the DOL is issuing guidance that says if it goes this way, we'll do this, and if it goes this way, we'll do this. We really think that given the confusion around repeal and replace, we'll have an awful lot of that as well. So let's go to the second constituency, carriers, vendors. And the reason I say carriers, vendors is this isn't all about insurance anymore. It's also about service vendors in the space, whether they're telemedicine providers, wellness providers, et cetera. So the first issue, especially on the health insurance side, is consolidation, but then I say consolidation almost. The DOJ came down, as you know, against both proposed mergers. It appears that one side is completely walking away and perhaps others are going to contest it. But we continue to see this ongoing trend of the commoditization of health insurance. When I say that, I'm really speaking about the gradual, perhaps precipitous reduction in actuarial values across the board. And as I said on the last webinar and made the case, as you move further down the actuarial value curve, it really accelerates that commoditization. And the only way to establish value in the benefit program is in programs other than major medical insurance. And I think the major players are seeing a reduction of insured participants, right? Whether it be in the individual market or the employer market, as premiums increase, people predictably make a decision to drop insurance. The individual mandate penalties have not been substantial enough, at least for lower income individuals, to bring them into the marketplace. The priorities for carrier and vendors: individual market, they've got to fix. Of course, the fix for many of the folks in the individual market has been to exit. That's been their fix. So if they could get back some more profitable lives in that market, they'd be very excited. Medicaid and Medicare are a very strong focus for the carriers as well. A lot of carriers like Humana and others working on the dual eligible or the Medicare supplement world, Medicare alternative. And we're seeing an awful lot of product service proliferation where because of declining profits on the health insurance side, the desire to really move into other areas that are complementary and add value and return that revenue and profit that is important to them as all public companies. What's the impact of the replacement plan on these carriers and vendors? We think there's going to be a continued revenue and profit squeeze. While the Trump administration is very friendly to many large businesses, I've not yet seen those folks come in through his office. We know there's going to be some squeeze on pharma, and we think that the same thing is going to be true here. We do believe there's going to be new competition if the replacement plan goes through. The parameters around providing insurance are going to be loosened, and we believe that there will be more eligible product. The focus of Secretary Price, if you read his writings over the last 4 or 5 years, have been providing people increased choice. Even if you might not think it's good insurance, they may think it's perfectly adequate for them, and if we don't provide it to them, then they won't buy. And then we expect that there's going to be more movement in the carrier space around from business to business distribution to business to consumer distribution. Much of insurance today is either distributed business to business or business to government. If you listen to the CEO of Aetna, for example, he anticipates that the marketplace will move more to business to consumer distribution of insurance. We expect that would be the case as you see premium reimbursement in the small employer market being brought back on the table. But I also think it has a relevance as it relates to employer distributed insurance, which increasingly is becoming business to employer as the next business, but then to business to consumer. As employees, as consumers, have more choices, whether that be through ancillary and supplementary benefits, whether it be through exchanges. We see a broader movement of trying to change the employees from entitlement to actual consumers, not only consumers of their benefits, but consumers of the benefits once they choose them, but also consumers during the choice process. So let's move to employers. Employers, the number one issue we hear from employers, especially in the realm of the ACA, is the demands of compliance and the demands on their staff. Second is the continued rising costs and the squeeze on compensation. So it's interesting, as I said before, there's little focus from the government on the employer market because everybody's declaring victory. They're saying the 150-some million Americans who get their coverage through through their employers, have really had the lowest rate of increases in their health insurance premiums of anyone else. While that's certainly true, the employers we talk to that says just because it went from 15% to 7%, 7% now on a pretty big number is still higher than our pricing power. So therefore, we've got to do all we can to abate that cost. I think the other thing that is creating this is the squeeze on compensation. We're at near full employment overall, but employers continue to tell us that they're actually at negative full employment, meaning they can't find people in the relative skill positions, and they're seeing demands for compensation increases that really harken back to the web days. The last issue that we hear more and more about is the age diversity of the workforce, and the fact that there are distinct, definable populations from baby boomers all the way down to millennials, and the needs and the values of that diversity creates challenges when both designing and delivering benefits. Priorities. Number one seems to be cost containment through programs. So, whether that program be a telemedicine program, whether it be a new analytics program, and a prescription drug optimization program, chronic care management for certain disease states, these programs tend to metastasize, and they all create additional demands, but they're all about cost containment. Also taking a broader view of their benefit program, where benefit programs used to be, health, dental, vision, life insurance. Now they're broader into supplemental coverages, into things like student loan repayment programs, into overall financial wellness. And as I said before, the focus really is on getting to, whether you call it employee buy-in, whether you call it engagement, or whether you call it employee consumerism, that really becomes the movement, and that's the priority for employers. So what is the impact of the replacement plan on employers? The first, perhaps, is regulatory relief. If you read the plan as proposed by the Republicans, you see an awful lot of those regulations being removed. And I can also share with you that if you hear about the three-phase plan, the three-phase plan is based upon repeal of the Affordable Care Act through reconciliation, so that it would only take 50 votes. Then they talk about the regulatory power that Secretary Price has, and they're speaking about 141 different points of regulatory discretion that he may have. We would expect that many of those will impact employers. And then the final is a replacement for things like purchase across state lines, et cetera, which is legislation which would require 60 votes in the Senate. That's the three-phase prong. Second, that we think, and this relates to earlier discussions that I've had with many of you, and that is one of the things that we thought was important about the Affordable Care Act is, for the first time ever, it put down channel markers with regard to employee benefits. For the first time, an employer really had guidance around who they had to offer benefits to, what they had to offer, and how they had to price it. Well, if Obamacare is repealed, we could end up back in an environment where the employer has broader latitude without channel markers, and I think we'll see some movement there because of that. And then the last is really managing employee perceptions. Again, I think the challenge for employers is that much of the discussion, the rhetoric, and I call it vitriolic rhetoric, really doesn't affect them, and yet it does affect them as citizens. And we're going to have to try to keep them focused as much as possible on their benefit program and the value that it offers to them. So let's move to employees. Top three issues. First issue is we continue to look at the benefit illiteracy of the general employee population. The small percentage in a recent survey of employees who could actually describe accurately what a deductible was, what an out-of-pocket, what a copay was. And so in many ways, you've heard me say in many ways they're like that Penn State linebacker who had a bad practice, and a coach came up to him and said, "Son, are you ignorant or apathetic?" And he said, "Coach, I don't know and I don't care." And so getting employees engaged to overcome that illiteracy is a large issue. Second is employees increasing risk exposure. As we all know, one of the primary mechanisms that we have to control cost is to reduce actuarial value, or perhaps provide more choices of actuarial valued plans. And as we've all seen in various decision support and actual field implementations, many employees will trade premium for additional risk exposure and be perfectly happy with that until they have a claim. So dealing with that risk exposure is a very large concern. You hear people now reverting back to the kind of good insurance pays for everything and lets me go anywhere I want to go, and bad insurance is the opposite of that. So education in that environment is difficult. I think the third thing is really the flip side of the employer's challenge around full employment, and that is alternative labor opportunities. And being able to, we'll talk about this, being able to fully evaluate a total compensation package is probably not something that employees are very good at. And in the world of LinkedIn and near full employment, I can dare say that a larger percentage of employees are looking at their options than clearly they were back in 2008, 9, and 10. So what are their priorities? What are our priorities with regard to employees? First is making better decisions. As employees figure out that perhaps they chose a plan that didn't have the greatest results for them, they get very much focused on making better decisions about their benefits. The second thing is as their benefit programs become more diverse, taking advantage of all of the benefits that they have. We increasingly hear from employees that they're surprised that they had a particular benefit. If they knew about it, they would have taken advantage of it. And then the last is their overall financial wellness at the lowest possible cost. So we have all heard the stories and have experienced perhaps in our own families the struggle that millennials are having with the high levels of student debt that they have. And if you hear a financial planner talk about uses of discretionary cash, they will always kind of walk through the retired debt, develop a rainy day fund, participate in your employer's 401k, max out your 401k, etc. Nowhere in that waterfall of discretionary cash is any advice around what are the proper financial protection products I should have for health and wellness, the area that we deal in every day. So that's more broadly what they're looking at now. So impact of the replacement plan of employees. The first one I think is pain at the water cooler. Again, it's a highly politicized environment. Everybody's going to have an opinion on it, and that's going to be difficult. I think that given the current replacement plan and the significant impact that it has on returning the population from the pre-Medicare population in the individual market, the 50 to 64 population, returning them to an environment where insurance is significantly more expensive in the individual market than it is in the group market could cause some challenges there. And I think it'll manifest itself in some adjustment to pre-retirement planning. So last but certainly not least, as we go across the country and we talk to brokers and consultants, their top three issues first are industry consolidation, which kind of creates some movement and some competition. Probably even a bigger issue is the increasing cost of providing service to your clients as their needs grow and become more diverse, and that proliferation of products and services, just keeping up with the latest and greatest ideas that are being offered by the carriers and vendors and rationalizing those ideas into a solution for your clients. Your number one priority really hasn't changed, and we know that because we deal with you every day, and that's responding to client needs. When When your client needs something, it immediately becomes a portion of your job, either to source it or to provide it. And that's been our source of input of needs over our 20-year history. Second is around simplifying service delivery. What we hear from our broker partners across the United States is that it gets very difficult to manage when every one of their clients is absolutely different. And so trying to simplify that service delivery and make it easier for you as you deal with multiple carrier partners is important. And then finally, balancing tactics and strategy. As we all know, for the past 4 or 5 years, we've really been in the thick of a calendar-based implementation of the latest regulation. And we've felt very, very tactical. And many of you have told us that we'd like to return to an era of being able to manage a client through a multi-year plan around how they're allocating compensation to benefits and how they're controlling costs. So the impact of the replacement plan, I think further confusion. And that's not confusion on brokers and consultants' part. I think it's confusion in the clients. I think it's confusion in the carrier partners and confusion in the regulators. I think there will be, though, some return to creativity. As the navigational beacons are taken away, if you will, then we're going to see some return to things like broader premium reimbursement plans and perhaps limited medical and executive reimbursement and some other things that that the ACA kind of put the kibosh on. So, perhaps we'll see some of those things come back into thing. But clearly it's going to be a busy 2017 and 2018. So the post-ACA world, as we look at all of the 5 constituencies, I think we can stitch together what we think are some common themes. Those common themes are increased complexity. We certainly saw that as the regulatory complexity, the carrier vendor product proliferation, the employers have ability to access different products and need to access different products to make a full benefit package. And the employees clearly dealing with multiple choice medical plans and all the complexity that they don't yet understand. Second would be rising costs. I think many of you would share with me that the concern of ACA is there was really little in it that addressed either the unit costs of healthcare or the number of units consumed, which are at the base of the rising costs. Well, we really don't see anything in the replacement plan that does that either. It really is still a plan about insurance and tax credits. And then finally, this theme of expanded consumerism, of the employees' increased role or responsibility, whether they want it or not, the transfer of how employees choose benefits and use benefits and giving them tools to help them do that, and more than that, making sure that they're both aware of and they use those tools so that the programs put into place by the brokers and consultants and the employers are at their most effective. So what is the Hodges-Mace response? Well, we partner with you across our platform, whether it's Smart Ben Assist or other things, to really take on those regulatory burdens, take on those HR assist burdens, really smooth benefits. Well, we're announcing today in the first quarter, we've got a new program that we really think is on target for the trends that we're on, and it's called Smart Ben Now. Really about providing innovative enhancement to help employees both choose and use their benefits. It is available in a mobile application as well as a web application, and in short, what it does is it provides a simplified presentation to personalized benefit information that gives the employee access to all information about their benefits, gives them very quick access also to cost-saving programs, so other programs that you put in place like telemedicine, like RX optimization or cost optimization. And then it provides a platform where the employer can also deliver reminders and alerts directly in the palm of the hand. So in kind of a classic mobile application strategy, we're delivering user-relevant content which will encourage the employees to both download and use the application. as they use the application, we're also showing them other things that perhaps previously weren't as accessible to them. Telemedicine, access to their EAP, which will further drive productivity, lower costs as well. And then once we've done that, there is an open conduit for us to push relevant messages to them. We just had an employer the other day that told me and said, I can't send one more email to my employees. And so that we believe that messaging platform is incredibly important. The other thing that I'd point out is that it provides enrollment access as well. And another product that we're announcing is Pathfinder on-demand decision support. You can ask your Hodges-Mace representative about that, but it's an enhanced view of the intelligent process to choose and select benefits. So we now have multiple paths along the Pathfinder, which is really the wizard, if you will, and then Pathfinder on demand, where just the employees that want to use that can use that, and they can choose that dynamically. So we think that's going to have a significant impact. Well, why a mobile strategy? Well, the mobile strategy for us was obvious because you look at 83% of the workforce now owns a smartphone. It is that point of real estate that can provide the greatest access to them. So how do we think this relates to the themes that we were on? First is reduce complexity. We believe that the immediate access to critical information will reduce that complexity. The simplified integration with multiple portals, rather than having 11 portals, the portals are able to be accessed directly off of this platform, and quick access to ID cards. Increase consumerism. SmartBend now will keep the benefits top of mind by delivering relevant real-time data like their exposure, their remaining exposure to deductible, their remaining exposure to out-of-pocket, their PTO balance, their 401k balance. Those kind of pieces of information will keep their entire benefit program top of mind. Will also drive increased utilization of the consumer tools that you're trying to roll out. And then finally, we believe that it will have an impact on your efforts to reduce cost. Both on the service and support side, because it answers routine employee questions without having to go to AR. It does increase utilization of cost-saving programs, and because it's vendor agnostic, it facilitates vendor changes without having to worry about the switching costs of the people that might have adopted that particular vendor's portal in the past. So if the markets change and a particular vendor has better rates, by using SmartBend now as an aggregator, you'll be able to seamlessly change that vendor underneath and therefore deliver your cost objectives. So what we've attempted to do today is to really give you some insight into how Hodges-Mace thinks around the 5 constituencies and their various reactions. Hopefully we've provided you some additional insight, perhaps a couple of things that you hadn't thought about before, and to give you also a sneak peek at how we're responding to where we think the market's going. Lee, I'll turn it back to you.
Great. Thanks, Eric. So I know we are up against that 30-minute mark, folks. We do have some wonderful questions that we've received. So what we'll do is I'll actually get with Eric after this. We'll get the answers to those questions, and we will send out an FAQ along with the recording and the slides after the webinar. So thank you all for attending, and Eric, thank you for being here. We really appreciate it.